wealthlift.com. Welcome to Lesson 3 of the Wealth Lift Beginning Stock Investing Series. What makes a company valuable and what makes a stock a buy? In this Wealth Lift video lesson, you will learn what makes a company valuable. What's the difference between a great company and a great stock? What are some other key indicators investors look at when valuing a specific stock? How do you find the information you need about companies? What makes a company valuable? We learned about the different types of stocks that investors look for in Lesson 2, Strategies for Stock Investing. But now we need to start looking at trying to value specific companies. There are a number of factors investors look for when looking for stocks to invest in. The product. This is the factor that people are most familiar with. What does the company actually sell? This could be a simple range of products like computers and computer accessories for Dell Inc., or a huge range of different products, such as for General Electric, which sells everything from aircraft jet engines to financial products. The product could be a service rather than a good, such as the banking services provided by Bank of America. Once you know what a company sells, you need to figure out exactly who buys the product and what sort of things affect the revenue generated from that product. If Dell Inc. sells most of its computers to businesses rather than consumers, you need to consider what kind of spending decisions companies are going to make. You need to also consider what makes that product profitable for the business. One thing investors often look for is the scalability of a product. For example, Microsoft develops one version of the Windows operating system once every several years, and then sells millions of copies of the same product for the minimal cost of packaging and pressing a CD. These sorts of product features are the difference between a good company and the next multi-billion-dollar company. Competitive advantage. While great products generate good profits, there will always inevitably be competitors who pop up and create similar or better products. The true difference between an average company and a hugely successful company is having a competitive advantage, which refers to anything that prevents competitors from simply copying your product and undercutting your prices. This competitive advantage may simply be economies of scale, where companies can produce goods for much lower cost than their competitors due to their size. An example is a company like Intel Corp. It takes a production level of thousands of computer chips a day before this business can be cost-effective. Any small competitor cannot match Intel on price, and so any new competitor would have to invest billions of dollars to scale very quickly and must gain market traction very quickly to be profitable, which leaves Intel as the industry leader. Another competitive advantage is the power of branding. Nike Inc. can consistently charge much higher prices than its competitors because people recognize the Nike brand name and are therefore willing to pay price premiums that they would otherwise not be willing to pay. This leaves Nike as one of the most profitable apparel companies in the industry. Company assets. While competitive products are what determine the long-run success of companies, there are other valuable assets that companies may own or control that investors also look for. These include tangible assets such as cash, land, buildings, and equipment, as well as intangible assets such as brand names and technology patents. Value investors in particular look for these kind of assets. The net assets per share of a company is calculated as its tangible assets minus its liabilities divided by the number of shares outstanding. For example, one of the greatest investors of all time, Warren Buffett, began his career as an investor by buying companies which had greater net assets per share or book value per share than their stock price. In fact, Buffett's $186 billion market cap investment holding company, Berkshire Hathaway, initially had its start as a struggling textiles business that Buffett bought a controlling stake in because it had greater net assets per share than the stock price was pricing in. What's the difference between a great company and a great stock? Remember from Lesson 1, What is Stock Investing?, that earnings are ultimately what adds value to companies. Investors look closely at the past profitability of a company. Specifically, investors look most closely at earnings per share, or EPS. This number represents the profits of the company divided by the number of shares outstanding. This number is extremely important because, at the end of the day, earnings are what make companies valuable. Investors focus on EPS rather than just earnings because if at any point a company decides to issue more stocks, each shareholder owns a slightly smaller portion of the company in what is known as stock dilution. If the number of outstanding shares grows faster than the overall earnings, then EPS falls, and an investor's share of the company's earnings is shrinking. Because of this, a steadily rising EPS is what investors look for in companies. We spoke briefly in Lesson 2, Strategies for Stock Investing, about the price-to-earnings ratio, or PE, of a company. The PE ratio is the current stock price divided by the earnings per share and represents the multiple of earnings you are paying for the stock. For example, if you have a stock trading at a price of $20 with an earnings per share of $1, then the PE for the stock is 20. Once we have the EPS number for a company, it is easy to calculate the PE ratio. The price-to-earnings ratio of a company is equal to the company's current stock price divided by its earnings per share. This number is extremely important. We spoke earlier about great products, competitive advantages, and company assets as things to look for in a company. However, there is a big difference between a great company and a great stock. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The price you pay for a company is just as important, if not more so, than the quality of the company itself. For example, at the time of writing, Google Inc. trades at a PE multiple of 20.16, while Walmart trades at a PE multiple of 11.73. Few people would argue that a mature brick-and-mortar company like Walmart could possibly grow at the same rate as a relatively young and growing technology company like Google. However, an investor buying Google stock pays almost twice as much per dollar of profits for Google than an investor buying stock in Walmart. Therefore, the market has priced in growth for Google. We will discuss PE ratios and the exact valuations of stocks in Lesson 4, using discounted cash flow analysis to value companies and stocks. But for now, it is important to realize that the price paid for a company is just as important as the quality of the company itself. Understanding this idea is a huge part of moving from being a novice investor to being a sophisticated, informed investor. As a good rule of thumb, a PE above 11 for a company indicates the market expects the company to grow its earnings over time, while a PE at 11 indicates a company will have zero growth in profits, and a PE below 11 indicates the market expects lower profits than the company's most recent profit numbers. What are some other key indicators investors look at to value a company? Another key financial indicator investors focus on is the debt held by a company. Obviously, if a company has a large growing debt and no way to address it, they will sooner or later be paying a large portion of their profits out as interest on the loans and face a growing possibility of bankruptcy. To get a quick idea of the debt level of a company, investors often look at the debt-to-equity ratio. Equity is the remaining value of a company after debt is removed, equal to company assets minus company liabilities. The debt-to-equity ratio is equal to the debt held by the company divided by its equity. The debt-to-equity ratio is important because it quickly tells the investor if the company has enough equity or assets in excess of liabilities to cover its debt. Usually any number below 0.5 is fine. A number between 0.5 to 1 needs to be considered more carefully, and any number above 1 needs to be considered very seriously. It is important to note that some capital-intensive industries such as car manufacturing and industrials often have debt-to-equity ratios of around 2, but this is not considered unreasonable due to the nature of the business. Most importantly, these indicators should always be compared to competitors in the industry and other benchmarks rather than taken by themselves. How do you find the information you need about companies? Now that you know what to look for when valuing companies, you also need to know where you can find this information about the companies you're interested in. The original source of all this information comes from the annual and quarterly reports that publicly listed companies must release by law. In the United States, these report filings are required by Securities and Exchange Commission, SEC. The SEC has an electronic database with every filing from every listed company in the United States available online at the SEC EDGAR database. The most important documents in this database are the annual financial reports of companies, also known as the 10-K annual reports. In this database, you can look up any listed company in the United States and find their 10-K, which includes an income statement with all the company's revenues and expenses, a balance sheet with all its assets and liabilities, and a cash flow statement with all its cash flows. However, the SEC database is complicated, and company financial reports are even more convoluted. It is better to use an existing stock research website that aggregates key financials of a company to begin screening companies. For example, to see the PE or debt-to-equity ratio of Microsoft, you can simply enter its stock symbol MSFT on the WealthLift stock research page to get a summary of key financial statistics as well as financial charts over different time periods. In this way, you can look at up-to-date financial ratios and indicators of any listed stock. Over time, it's a good idea to learn to read SEC filings as they contain important financial notes and other information not usually available in financial summaries of companies. In the next WealthLift Beginning Stock Investing lesson, we look at discounted cash flow analysis, a way to put a price on the future earnings of companies and discover undervalued stocks.